Hello and welcome to today's video. In a recently concluded video series, Becoming a Seasoned Investor, we discussed about how one should choose a trading or investing strategy to meet his or her personal goals or the dreams in life. In this video, we'll dig deep into one such strategy, which is the buy and the hold strategy. We'll try and understand what's in it for you and should you choose this as your investment strategy. So like this video right away and subscribe this channel so this video can reach a lot of people. See, by definition, the buy and hold strategy says that you buy a security and hold it for a maximum period of time, almost always forever if it's a very good security. It may be because you believe on the long-term return on that stock is more than the short-term volatility of that particular stock. Now, with this strategy, you oppose the absolute market timing. As for those investors who imply this strategy, they believe that time in the market is more valuable than timing the market. They believe it's far easier to spend time in the market than to try and time the market perfectly. Now, we know that this strategy is to buy a particular security and hold it for a long time. But for how long? The time, how long, is defined by the reason you bought the security in the first place. If it's for your retirement, you might probably hold it for a long time until you retire. If it's for a different purpose, you might square it off in between and fulfill your dreams. So do you recall this strategy with something which is very similar we discussed earlier? I think you got it right. It's the efficient market hypothesis. I'll give the link for the video here in the I button. You can go and have a look at this, what it is exactly. With the efficient market hypothesis, which tells us anyway you would know that any stock market analysis is irrelevant because the price of that particular security has already been considered into it. Because it believes that any information when it has eventually reached our ears has already had its effect on the particular security. The price, the movement, the volatility, whatever you have seen in the market happening with that particular security is because of the news which you have just received. You're not the first one to get it. This theory, however, counters the active investing strategy, which involves technical analysis or analyzing a stock and finding out the volatility of the market and then taking advantage of the volatility or the fluctuation of that stock pricing and so on, and actively managing and being in the market in search of a small profit, in search of a small movement in a particular stock. It counters the active investing strategy, which requires a lot of research, trading skills, investing skills, and spending tons and tons of time in front of the market in order to beat it. And to nail all these efforts, to nail the market timers, this theory believes that all active investors, they cannot be more efficient than those who buy and hold a particular security for a long time. So an active investor is not more efficient than those who buy and hold in the market. So why this struggle? If this is true, then why bother learning technical analysis? Why bother scratching your head, looking at the graphs and buy pressure, sell pressure, so on and so forth, and so many different calculations, and facing the market volatility, spending 8 hours in the market trying to find out what's going to happen, what's next. It's rubbish. If that's so, if doing all this doesn't help you much, isn't it better to just simply buy and hold and spend your time outside, do something else? Simply analyze some good stocks, buy and hold it for a long time. And instead of banging your head for a few, maybe a minor return, a minor difference in return, it doesn't make sense to spend a whole lot of time in the market. I think it's wise to buy and hold in the market and do what you love to do. Follow your passion. So what does it mean for you? So to briefly define, this strategy is for those who have a very low risk appetite and ample time in front of them. And for someone who doesn't have the time to spend in front of the market in anticipation to beat it and hunt for small opportunities to capitalize on those gains. Already feeling excited? Let's make it more interesting for you. This strategy saves a lot of cost. Why? As it requires very less frequency of buy and sell of securities. So you spend a lot of time on transactional charges, brokerages, and most importantly, you save on the short-term capital gain tax. Also, it's less risky, as the risk of facing the market volatility and making the human error in facing the volatility is greatly reduced. So when something is less risky and it gives a good cost saving, it makes the strategy more simple than other prevalent options available in the market. Well, hold on, before you decide to implement this strategy right away, because there are certain risks too. The biggest of them is the price risk. See, when you buy and hold a security, you most probably look at the fundamental analysis, or you do the fundamental analysis of the security, and most probably you do not look at the price at that point of time. And what it does is, most often than not, you tend to buy a security if it is good, fundamentally strong stock, and you buy it because you know you're going to accumulate this for a very, very long time. So maybe at the point of buying the particular security, it may be trading at a very, very high price. Maybe it's trading at a very, very high price, but you buy it anyway because you are not there to capitalize on the volatility. You're there banking on the business performance of the particular security, which means you at times end up buying a particular security at a very high price than it's required. In association with that, there is also a price risk. Now, the price risk is something which comes if the security tanks down. When you buy it and the stock doesn't go up, rather it comes down, you don't even get your principal back. Finally, the buy and hold strategy reduces the flexibility that you have in the market. You buy and hold a stock forever. You tend to come out of the market. We just discussed this. You do a fundamental analysis. You find this particular company is doing very good. The fundamentals are good. You buy and keep it with you forever. You do not sell it. You are not a part of the market volatility anymore. You are out of the active market participation. This negates the possibility of making good returns when the market is fluctuating, probably when the market is dipping down or maybe it's falling down by a huge margin. You probably miss out on a good return. You could have sold it, bought it down and sold it back when it's up. So you negate this possibility. Why do I say this? To cite some examples for those who traded the market during the 2008, 2013, 15 or 2020 pandemic times. They generated more returns than those who simply bought and hold on to a particular security for a long time. So people who traded the market in those volatile market times, they generated more returns than those people who stuck to a buy and hold strategy. Now, does it sound too demotivating for you? Citing the advantages which I have listed earlier? Well, if I were to answer this question, here is my approach. If my risk appetite is low, if your risk appetite is low, I would suggest you to stick to this strategy and don't be too greedy. But if I have a very, very high risk appetite, if I can handle the market volatility, if I can be at ease, taking into consideration looking at the market fluctuation and still yet have a peaceful night's sleep, probably this buy and hold strategy is not meant for me. I would rather be more excited to be in the market, to be actively trading the market and trying to time the market and capitalize on those small volatile fluctuations and getting the benefits out of it. That would be my probable strategy. So it depends on the kind of person you are, the kind of feeling, the emotional stress that you get from the market. You should follow and take up that strategy as your investment strategy. So first, see what kind of person you are. Are you able to handle the market fluctuations? Can you handle the market fluctuations? Can you take the volatility of the market and yet have a peaceful night's sleep? If you can do it, well and good, then probably the buy and hold strategy is not meant for you. probably it's good for you to be in the market, to try and time the market, to capitalize on the small volatility or the small fluctuations that happen in the market on a regular basis. On the other hand, if you're really afraid, if you're really scared, if your heart beats faster with every fluctuating movement of the market, then probably I would suggest you to stay away from active trading and be in the market, do a strong, good, thorough fundamental analysis of a particular security, buy it and hold it for a very, very long time. That would give you a peaceful night's sleep, and yet you would probably make almost similar returns to those who are actively trading in the market. So does it sound good now? Well, I hope it does, because the answer to this question really lies on another question. What is your risk appetite? That's all for today. See you again in the next video. Till then, SG signing off. Goodbye.